Ready to get an edge in options trading? Understanding implied volatility, or IV, is your ticket to smarter trades and better strategies. Stay with me as we uncover what IV is in options trading and how to use it. Too many traders ignore IV because it seems complicated, but by the end of this video, you'll not only understand IV, you'll know how to use it to your advantage and avoid costly mistakes that can cost you money. So in today's video, I'll give you a simple explanation of what implied volatility is in options trading, and you'll use it. You'll know how to use it to make better options trades. And stick around until the end because you'll want to know what an IV crush is and how to avoid it so you don't end up losing any of your money. Now, IV, one of the best ways to think about this is let's leave the stock market for just a minute and let's talk a little bit about your insurance policy and how you drive. You probably know drivers like me that are very aggressive, and we move a lot and we brake and we hit the gas and we corner pretty tight. That'd be someone who you might say, boy, he's pretty volatile behind the wheel. Then you got my wife. I mean, my grandma drove faster than my wife does. She's very safe, hands at 10 and 2, and she's going to stop and brake and check her blind spot. She's not going to speed. She's not very volatile. So if you were an insurance company and you were going to charge insurance and look at both of us as customers, which one do you think you would want to charge more money? Well, it's certainly the more volatile driver, the guy like me that says, hey, man, let's put the pedal to the metal, let's roll. And that's how insurance is. You could do the same thing with healthcare. I've been through a little bit of sickness now and again. I'm a cancer survivor. My wife is a cancer survivor. So when they call, wanting to sell me health insurance, I get rid of them pretty quick. I say, yeah, I'd love to talk to you about health insurance. By the way, I'm a cancer survivor. Boom, the tone goes dead. Phone goes dead. And so one of the great ways you can tell about if something is volatile and has a lot of risk to it is how much premium you pay. Well, in the options market, there's several factors. There's how much time the policy would be for, the contract is for. There's certainly price of stock. But underneath the surface, the people that price options, those models, those Black-Scholes models that price the options, they're considering how volatile this stock is and how crazy it can go. So just as an insurance company wouldn't just charge everyone the same for insurance, they would look at age, they would look at how long the policy is, and they would look at how volatile or how risky this could be. Now, if we translate this to a stock chart, we can find stocks that don't wiggle very much, like maybe a Procter & Gamble or something like that, a Kraft Heinz. They don't move very much. Hey, Kraft Heinz, they're selling ketchup. There's not much to that. But boy, if you were to start doing drugs, start going to some of the pharmaceutical companies, man, they're volatile all over the place. Why? Well, ketchup is ketchup. We're not really innovating. In fact, we're really trying to keep it the same. But with pharmaceutical companies, my gosh, we're innovating. We're trying things with the government. We're trying to get things approved for the FDA. And boy, if they don't work out, they can really drop. I would say with any stock, though, the most volatile time is around the earnings. Quarterly, they'll report their earnings. And so we kind of have this suspense building up going into the earnings. The implied volatility will increase because the closer we get to that earnings date, the larger the chance that thing can move. And once that earnings date comes and they announce their earnings or losses and their guidance for the future, that stock can move probably more than generally any other time, barring some crazy news story. So one of the things options traders do not understand, especially beginners, is that once that earnings report is released, and we kind of know where we are and what the company's doing, boy, that volatility, that implied volatility just drops. We call that a volatility crush. Well, think about this. As I've gotten older, I guess I haven't been quite as aggressive. In fact, I haven't had a speeding ticket in over 20 years. And so the truth be told, their vision is that my volatility is going down. I can hop in my Tesla and they can see, the insurance company can see how crazy I drive or how safe I drive. So if all of a sudden I have a volatility crush, meaning I'm not crazy anymore behind the wheel, then the cost of my insurance will also drop drastically. So a lot of people will look at just the stock price or the amount of time they have in an option, and they won't pay attention to that volatility when a volatility can build or a volatility can crush, and they wonder, why am I making money or losing money? Why is the value of my option changing when there hasn't been much time go by and maybe the price hasn't changed much? Could be that volatility crush. How do you know? Look at earnings. We have indicators. You can see IV. It's a really important thing to consider when you're buying an option or when you're selling an option, because you can get killed by a volatility crush, but we also have trades where we can make money on a volatility crush. And I will tell you this about volatility crush. There are certain companies, like FedEx is a great example, Facebook is a great example, that have large, pronounced, and consistent volatility crush. Look, very difficult to predict the price, very easy to predict time moving on. That's Monday moving into Tuesday. Also not so bad to predict the implied volatility and when that baby crushes. So that's another way to make money and exploit opportunities in the option market, but it's also something to watch for if you're on the other side of that trade. So implied volatility, or IV, absolutely essential part of your financial education for sure. Learning implied volatility is just really scratching the surface of everything there is to know about trading options. If you want a complete beginner's guide to trading options, check out my video here. And if you found this video helpful, don't forget to like the video, subscribe to the channel, hit the bell notification so you don't miss the next one.